We welcome you all to our recording of a previous PACE webinar, Building Internet Fiber Network Services and Capturing Investment Value. This webinar happened yesterday, but we had a technological glitch and the recording was not captured. So today we are re-recording the webinar without all of our wonderful participants and attendees from the PACE community. But we have their questions, and we are going to address their questions from yesterday in this recording today. We are also missing one of our panelists, but we have his comments as well. So thanks to everyone for the patience to return and recreate this wonderful content for all of our PACE community colleagues and for our PACE content libraries here. Our featured presenter is Jared D'Souza, who's Managing Director at Distinct Capital Partners and is an executive business partner who works to bridge between the operations and finance functions in organizations. He has a great background in senior finance roles in financial software, telecom, and manufacturing, where his focus has been on customer and product profitability. I am Monty Swain, one of the moderators. I'm a professor at Brigham Young University, focusing on management accounting. And I'm joined in moderating this session by Rafe Lawson, the IMA Vice President over Research and Policy and Professor in Residence. Rafe is doing a lot to manage the technology in the background, but today he will also represent our participants and their wonderful questions from our actual event yesterday. Thank you, Rafe.
I should be here.
Our panelists are Gary Kokens, Doug Hicks, and Larry White. Larry is unable to join us. He's on an international flight right now, but he is with us in spirit. Gary is the founder and CEO of Analytics-Based Performance Management. Gary, would you just say hello?
Good to be here, Monty. Thank you.
Doug Hicks, author and consultant, president of the DT Hicks and Company. Doug just recently published a wonderful book on a story of a management accountant working to create analytical value in her organization. You should check it out. Doug, say hello, please.
Hi, Monty. Glad to be here.
And I failed to get Jared to give us a shout out. Jared, if you would, so that to see your face pop up on the screen.
Hi, everybody. I'm glad to be here. Thanks, Monty.
Glad to be here again, you should add. Thank you all for being here again. So here is our agenda. I have been working on introductions, and I've got one more slide as part of our introduction to provide an overview of our profitability analytics framework. Then we're going to turn the time over to Jared, who's going to provide an overview of today's case. This is like an MBA classroom we're in today, and we're going to discuss a case, an actual case based on one of Jared's clients. And then our panelists are going to work to, using the lens of the profitability analytics framework, address some of the discussion questions. If you are watching this webinar and do not have the case can be downloaded from the PACE website, profitability-analytics.org. Then we had yesterday time to take questions and comments from our attendees. We got three themes that represented the content of those questions and comments, and Rafe is going to represent our colleagues from yesterday. Jared will then provide some conclusion remarks, and then I've got a comment or two about PACE and how to connect to us and continue these kinds of conversations and access the resources that we're developing at the Profitability Analytics Center of Excellence, PACE. This is the profitability analytics model or framework that we use as an overall structure for the work that we're doing at PACE. We evaluate, and there is a webinar on this profitability analytics model that we created several months ago, and that webinar recording is available on our YouTube channel and at the PACE website. And I encourage you to go there and learn more about this model. This is a very brief overview. We see three sets of timing or time horizon lens. The first there is a formulation of strategy. The core strategy of an organization, its market strategy, how it presents and positions itself in the world. This is the most classic strategy work that organizations do. With that in hand, then the operational strategy is how the organization implements and executes around their core strategy, employing their investments, both tangible and intangible investments, to resource that strategy. That threefold approach to profitability analytics, markets, operations, and investments transfers over to the causal modeling that is at the very center of the work we do. Modeling around revenues that obviously is most closely tied to market strategy, but works to represent the operational and be resourced by the investment strategy. The revenue model is based on a statement on management accounting, SMA, that the PACE group authored and is made available and linked to our PACE website, that works through some very specific core elements of causality and modeling with revenues. We have similarly an SMA on cost modeling, several statements on management accounting related to cost modeling. And there's and the focus there on causality is key. We have in process a statement on management accounting on the investment modeling, sustaining, expanding, innovating, securing, and complying, managing around investments. The final lens on the time horizon is strategy execution, which is fundamentally about forecasting and decision-making using these causal models based on a foundation of strategy formulation. And again, the threefold factors of revenue management, cost management, investment management, and the specifics there that tie to each other and are supported and represent the causal modeling. These results then captured in as key data creates a feedback learning loop to strategy reformulation and repositioning as this thing continues to learn and grow and tighten in organizations. This is the model, the lens we want to use in addressing Gerard's case. And with that, I want to turn the next 10 minutes over to Gerard to give us an overview of the case for those who haven't had the opportunity to read it and others who just need to be stretched out on it again. So Gerard, to you.
Thanks, Monty. Welcome, everybody. I just wanted to just go over the highlights, as Monty said, of this case. And just to put it in context, this occurred some 5 years ago when companies were expanding their fiber footprints to give high-speed internet to businesses across the country. Xanaf was, this is not the real company name, but as a mid-sized North American communications firm, had a core strategic goal to expand its fiber network. Really, it was part of its growth and profitability expansion goals. And really what they were doing was trying to get the commercial space to access their network, and they wanted to penetrate commercial buildings. They want to compete with large carriers in key metropolitan regions where they could increase market share of very profitable IP products. These are high-speed data products. And they also wanted to have to avoid leasing fiber networks from third parties where they had customers in other regions who had locations in buildings, and they would normally have to lease them from the major carriers. This would be an avoidance of that. So the initial strategy was, hey, let's just expand our footprint based on what we call something that's near net. Near net was within 220 yards of its national network, and they targeted a number of buildings in that near net space. That was about 3,000 buildings in the metro and cities that it went by. And then they gradually expanded the program to smaller cities where they would use business cases. So it wasn't so much distance, but it was business cases that would determine which buildings qualified. In the end, they qualified around 5,000 buildings nationally for this program. Next slide. So just this diagram shows you the sort of the way they were going about it. You can see the blue line here represents the existing fiber network that was already paid for. These access routes, they're almost like off-ramps off the main network, are to get to these targeted buildings. As I mentioned, they, with the help of marketing and network operations, they targeted about 5,000 buildings. And what they really did was they would approve a build once they signed a customer. It was not, we will build the fiber and then get the customer. They wanted to at least get one anchor customer in there who would pay for part of for the deal, or if not all of the deal, part of the deal, and then they would start the build. So that's how the deal will get approved. Their target was to have the payback. It was a simple revenue payback of 1.6 years, and MRR is monthly recurring revenue. So they'd look at that monthly recurring revenue, and if they got a payback of 1.6 years, that would be the target for those expansions. If the payback was not feasible, i.e. The revenue that was driven by that customer didn't get to that target, they would identify additional customers, and sales would have to have a plan to go and get those additional customers so they would eventually get the payback they needed on those buildings. So this was the plan, and it looked really good in terms of expansion. And let's go to the next slide.
Just, we're going to come back to it, but it's important to note that last point about how the build costs are being measured.
Yeah, the build costs are being measured. Yeah, basically they used a standard build cost based on average costs in each of the regions. So while they did have information on a typical build, there were some regional differences. You know, the eastern part of the country was much more expensive than the west. And so they adjusted for regional differences. And therefore they had kind of a standard cost that they used to evaluate these building costs, but they did track the actuals when they actually put these in play.
Okay, thank you. Next slide coming.
Okay. So, you know, the initial results, once the program got underway, the revenue IPCs, the Internet Protocol product revenue grew as sales did sign up new customers and buildings. This improved, the P&L looked good because gross margins were going up. The revenue was 100% on net, so there was no third-party lease costs or cost of goods sold in the actual margin on the P&L. The capital spend, which obviously goes below the line, was on budget because on average they were consuming just as much as they budgeted for. So everything looked reasonable. And the marketing group liked the fact that they were starting to show more on net buildings. So in the original metrics that were captured, everything looked really good. But if you go to the next slide, the part that was forgotten was the fact that this was an investment, and there were no real metrics to measure the return on these investments. While the number of on-net buildings grew, you know, everybody was glad to see them grow. There was no understanding of the return on that investment. Some of the building costs, when they took a look at them, were much higher than the estimates based on unforeseen obstacles in connecting the buildings. Some of them were actually near subways or near areas where you couldn't bury the fiber easily. Most of the fiber in the metro areas had to be buried because of bylaws, and therefore they were unforeseen obstacles that could cost like 20-30% more than estimates because of the extra fiber they would have to bury to get around these. There was also no evaluation on the return on investment for each building, so it was difficult to see how they were performing versus the business cases. Some of them were based on business cases, and without the knowledge of, you know, that first customer, that second customer, and the payback, there was not that sense of understanding of the return on the original investments. So what happened was, after, you know, several months, the firm they had an investment review committee, the IRC they called them. They recommend that finance, who I was part of at the time, supporting. With support from network operations and marketing, report on the building ROI. So that was the big ask from this investment review committee is, can you give us the ROI on this project? So finance did a deep dive on ROI. It was quite simple from a cost side, because the actual direct costs, and I point out these are only direct costs for the build. There was no sales, marketing, or any other customer support costs here. These were just simply the asset costs to build the fiber. They were captured quite succinctly in the firm's ERP project accounting system, which was excellent. It had fully loaded labor costs. It had all the equipment, the material. So we were very confident we were capturing all the costs to do each of the builds. However, it was not easy to link that cost, the CapEx cost, to the revenue. And finance, with the support from marketing and network, found a link in the data. It was a bit of forensic work, but they were able to link every circuit or every fiber that they built to a customer access in every one of the buildings, so we could actually trace the actual cost and revenue being generated from those buildings. So that was the one great feature that allowed us to do that link between, it was really a customer asset access network number that was the key. Can we go to the next slide? So the finance deep dive on ROI allowed a very useful report to be developed. It showed 544 locations, the building address, the region, all the standard stuff, the subsequent builds, completion date, the build cost, the booked monthly recurring revenue, the booked non-recurring revenue. There were some deals where the costs were quite high and sales was able to negotiate a one-time, what we call non-recurring income. The customer will pay up front for it, and they agreed to do it. And then we did a calculation of revenue payback on each of the builds, and then the total businesses in the location. So finally, they had a database of the actual penetration and the potential penetration of those particular buildings. Next slide. This report provided some really key insights, and this was something that the firm took some very quick action on. It was discovered that 51% of the buildings had 0 subsequent builds and had a revenue payback of 3 years or more. So that these were offside the 1.6-year payback target. And this was made, sales was made aware of it. They saw this in the report. And they were then given that report had the number of potential clients in each of the buildings, sales was going to target renewals and new customers in these locations, and incentives were then going to be given to get these additional sales, because the major investment was already completed. It was also discovered that 30% of the buildings had a build cost that was higher than the regional average. And this was an action for network operations. They were trying to do a lot of these build estimates based on Google Maps and a bunch of other remote features, but they concluded that it was worth the cost to send one of their network architecture guys out to the site prior to the build, and they would get any unforeseen costs. They would try to get sales to negotiate a non-recurring income from the customer to offset if it was way beyond our standard cost. 5% of the buildings had just 1 to 2 tenants, which was really not one. So some sales was, while the buildings were on the list, they found that these buildings didn't have more than 1 or 2 tenants, which puts them in jeopardy if those tenants move to another client. So it was critical for sales to provide excellent service to these customers and to renew these customers so that we didn't have any stranded assets. Also, there were canceled builds. For some reason, some builds were canceled. The customers signed up and then canceled, and the firm had already spent greater than $10,000 on these deals, and sales were following up, and eventually some of the customers did pay some of their cancellation charges. Finally, there were a number of buildings that had been on hold for more than 3 months. So there was a lot of CapEx tied up and sales was not really following up. So this report highlighted which ones they were, and they followed up with customers and they resolved any technical issues. So bottom line is a lot of good action was taken by this IRC-led request and the finance deep dive with marketing and network operations. So I think this was the status, and I guess we can go to the next section now, the questions from the panelists.
Thank you, Jared. We have a comment here just to the attendees yesterday to start lining up comments or questions to the Zoom chat box. And that the fact that they did that facilitated our ability today to still address those questions, which Rafe will handle. But now we're going to turn to our panelists and have them respond to this case from the context of the PA or Profitability Analytics Framework. These are the 5 discussion questions for this case. And again, if you've never been in an MBA classroom, you're basically in one now. The first 2 questions are probably where we'll find our best focus. First is discussing what are the strong points of this 5-year plan that Xanif has to successfully deploy its strategy of expanding its network, its fiber network, and building by building and customer by customer, and what could go better. We're looking at it from marketing, operations, and an investment perspective. And then the second question, how might the Profitability Analytics Framework, and if we say PA framework, that's what we're referring to, how might we use that to identify gaps in the company's approach to addressing its 5-year plan here? Again, here is the Profitability Analytics Framework from strategy formulation, validation, through execution, looking across market revenue, operations cost, and investment strategy and modeling. Let me turn off our slides now for a moment and bring everyone back to the front. I'm just going to adjust some spotlights here. All right, so we thought we might start with talking about investment management. That's what we did yesterday. Larry White was our panelist who is most best positioned for that. But again, he's on a flight to Africa right now. Doug, you mentioned that you might have something you'd like to comment on with respect to investments. And I have slides that I can bring back to the front if you'd like.
Well, I think one of the key things from a PA standpoint with the investment and how it related to the case was the fact that under profitability analytics, investment is just not the stuff we normally consider capital when we're doing our accounting. There's investments in things like marketing. Any marketing you're doing above and beyond what's required to maintain your current level of business is an investment. There's additional investment that would have to be made in doing other things, some of the things that they might have overlooked, such as the investing in a group to be able to go evaluate these places that they were considering adding the networks, instead of just standing back and saying everything's going to be average, everything's going to be like the industry. And these are all additional investments that would be required to execute the market strategy that they would have. So those are some of the kind of things that are often overlooked, is the things that aren't going to end up being put on the books and depreciated, that are also investments. Because again, in accounting, a lot of these things go below the line. They're treated as G&A, they're treated as those kind of things. But when you're making a investment decision, they're part of the investment as well. And in addition, just as sort of aside, is that under PA, can we look at the accounting for investments a little different? Not the standard capitalizing your investment and depreciating it based on a life you pick from column A and a method you pick from column B, and you crunch these numbers together and come up with a number you think is meaningful. We look at investment as what is the ongoing expenditure that you need to make in order to maintain the investment that you have. You know, you need to spend money to sustain and expand it, as well as to innovate, to make improvements, to keep up to date, to secure it, and anything you have to do in compliance. So it's not just the capital that's going out. It's the other monies you have to spend in order to expand your business into the way that they're looking to expand it to meet the objectives of their 5-year plan.
I'm struck by the what appeared to be a reluctance by sales and marketing to return to previous buildings that had been established with 1 or 2 customers and continue to expand more sales there. That seems like a natural and rather obvious path to take, but sales and marketing were reluctant to invest their capital, their own assets, their people, their time into that ongoing work. It's got to be related to how value is being measured there. Is a payback versus as an ROI, a return on investment.
Right.
And that investment, should include the things you're talking about, Doug, not just the cost of building, the capital cost in the accounting tradition, but all of the assets and investments, including intangible or at least unmeasurable in the the traditional accounting rules and general practices.
Right.
Any other comments? Yeah, please, Doug.
The view that a lot of people take when they look at this is they make their perspective that of what the accounting results will come out looking like, and so they use the GAAP type of rules and the accounting rules in deciding what is an investment, what is an expense, and where to look at it. Where when you're actually justifying a decision, you have to take a little different perspective as to what the return's going to be, what amount the investment actually is, because the economics of the situation are not necessarily how GAAP is going to have you bookkeep it after it happens.
As an accounting professor, we teach the GAAP approach to capitalizing investments is either, once we've made the initial investment, then only significant expansions of that initial investment should be capitalized formally to the balance sheet. Merely sustaining that capital investment is not capitalized or treated like capital investments, nor are costs related to innovating with or around that capital investment, securing the investment, complying with regulators or other contractual expectations, the cost of compliance around that investment's existence and work in the organization. Jared, along the lines of sustain, expand, innovate, secure, and comply, which of those particular aspects seem to be particularly relevant to this case and which are not?
I mean, sustain, obviously, once you've expanded it, there's a certain amount of network operations that would be needed. As you expand your fiber footprint, there's more gear. Sometimes there's gear, there's equipment at either end of these fiber expansions, so they need to be maintained. So there's a sustainment increase. There's increased security. We do provide security. And some of the compliance has to be in accordance with standards of security, although the actual data security is the responsibility of the customer. But it does, the expansion is the one key thing that's actually captured mostly in the CapEx. So the CapEx would track all the incremental costs for that expansion. Although you're right, there was not any. Marketing would have had extra resources to this thing. So would sales. That was not included. And therefore, I think a more holistic review of this project would be, we're going to spend this CapEx to expand the fiber footprint, but here's the non-CapEx investment, and here's the revenue generated by the whole program. And, if we hadn't done this, this is the revenue we would have lost, and this was the cost we would have avoided. So I think they look at it much like what you just said, GAAP. Everybody traditionally looks at GAAP and says, yeah, here's revenue, here's my margin, my EBITDA looks fantastic because it's all no additional. The OpEx, they didn't hire too many more people, so the OpEx stayed pretty standard. And actually, anybody that did hire was actually capitalized, but it was really the CapEx that was not being measured properly. I mean, depreciation goes below the line, and I think that's the kind of one of the reasons you said sales didn't go back is, they were looking like heroes. They were selling more, the revenues were going up, the EBITDA was going up, and everybody didn't look any further.
Didn't look any further than the EBITDA and the payback.
Yeah,
Doug
that's right.
or Gary or Rafe, not much about return on investment, return on the value, return of value on the investment. Do you have any comments along those lines?
I always thought that focusing on payback was an awful short-term view of things. It doesn't take into account what the lifetime value of having that building connected would be, and include the overall return on it. If it pays back in 1.6 years and then doesn't pay back anything after that, it looks the same as something that's going to generate that same kind of cash flow for 5 years, if that's your bogey. When you're trying to compare the value of potential investments, payback is a number that has some meaning as to how quickly you can get your money out. But there's a lot of other factors that are involved. It's one of the ones I cringe when I hear people focusing on.
Yeah.
I'm struck by there's a duality in this case that you used the term business cases that were made in this company, Jared. A business case that could focus either on the building and its value as a payback or its ROI, and a business case that could be made on the customer or customers, hopefully within each building, that we're looking at, both of these perspectives and needing to track on, value invested and value harvested, both from the building and from individual customers within that building. That's a significant data challenge, and the analysis to look, bimodally at value as a building and as a customer is a unique challenge for this company. Am I saying that? Am I representing that accurately?
Yeah, I mean, the key thing here is that, most of these, buildings have a long useful life, and the fiber you'd think would be there for quite a while. But the challenge was that in the competitive environment, a lot of the big carriers had fiber in these buildings as well. And most of the customers signed 3-year contracts, and there was no assurance that, as a matter of fact, some of these big carriers, when they saw, this mid-sized firm capturing business, they started aggressive pricing because they'd already spent money fibering these buildings. So it was a challenge. That's why payback was everybody wanted to get at least some of their money back quickly, because, unlike, Doug, if this was unique, we were the one access into the business like most cable companies have in residential areas. That's an asset for life. You've got whoever's at the other end has to get cable and internet. But here, because of the competitive nature and the big carriers had a lot of muscle, this was a way. So we'd have to get the customer, then compete on service and try to compete on price, because the big guys could come in and they had fiber in there from a couple of years ago. So it was a challenge.
Mm-hmm.
Let's move our discussion.
Let me just say one comment on that.
Please, Rafe. Yeah.
Maybe go back to that investment slide. This is what we're talking about here in terms of the PACE framework. And it seems like this organization had some challenges in each part of this framework. So, with regard to strategy formulation, and, Doug mentioned they were using this 1.6 year payback, how well did that integrate with the overall organization's strategy? And there may have been a linkage there, but it could have perhaps been thought out a little bit better in terms of what's the ROI and how long are our customers sticking with us after the 3 years and so on. So this is the formulation of the strategy could have been thought through a little bit better. In terms of strategy, validation and the analytics, we'll talk about this probably a little bit later, but depending on causal models, and as we'll talk later, is their modeling left a little to be desired. And then in terms of execution, that's there are these issues that we've seen in the case that with not following up on getting additional customers in the building and not perhaps planning on additional site work that was necessary to get the cable to a building. So just from this PACE perspective, we see that in each of these aspects of the model, the regard to investment, there were issues.
Thank you, Rafe. Let me step back here to our overall model and get Gary Kokens involved in our discussion. We'll get to hear from Gary. Gary is one of our great experts and consultants in cost, causality, and strategic cost and activity-based costing. We've been at the foundation of this framework, talking about the investment side largely of Xanif's particular strategy here. But if we're going to track profitability of buildings and profitability of customers, we've got to have a very clear measure of cost, and that's a highly rigorous discipline. Gary, what are your thoughts about cost tracking and causality for this company and the challenges it has or what it's doing well?
Let me step back to the beginning of the case. When I read the first few paragraphs, I was applauding them. I said, well, this is good. They were learning through doing and, making their mistakes early and often, not later when it's more difficult. They started to recognize some of the shortcomings, like of using the averages assumption. There's the old joke, my feet's in the oven, my head's in the refrigerator. On average, I feel okay. Well, it's disproportionate. But then I started to have a lot of questions, uncertainty, starting with their strategy, communication to the managers, how effectively they were doing that. And that would be a whole other discussion on strategy maps, key performance indicators, setting targets for the various managers, like, carrots with the mule and the donkey, to align the behavior with the strategy execution. But let's get to the cost side. What Gerard said is they were really using project accounting, which is a good thing in these building installations, because when you really think about the continuum of direct costing, project accounting is the highest form of any costing. However, if a fictitious organization, I don't know how many employees Xanif had, but let's just imagine they had 500 employees. Let's say 250 of them were these frontline workers in the projects. And typically projects are milestones, a percentage of completion, and that's how you do timesheets and all of that stuff. But the other 250, we would basically be support or indirect. And now comes the issue is, are we tracing the work and the costs of the activities of the indirect properly to these various buildings and client and customers and so forth? Well, if you assume that all the buildings and all of the assignments are homogeneous, then no problem. Just take the 250 and just divide it by some denominator. But let me just give examples that maybe some of the customers were basically constantly complaining, phoning headquarters, needing help desk work, maybe even needed field call repair and the like. And then in contrast, at the other extreme, there were some customers like none of that, they were just easy to work with. Well, we would want to basically be tracing, and this is where activity-based costing principles, I'm just going to call it principles. I know some people have this perception, ABC, it's too complex, it doesn't work. That's a problem from decades ago when people over-designed the models. They made them too complex. They don't need to be super precise. They just need to be good enough. So if I've got these low maintenance customers, and I'm tracing the work, I'm going to actually discover I may actually be underestimating what customers are really more profitable than they are and what opposite. So I guess a quick answer, Monty, is using causality principles, because that's really what activity-based costing is based on. It's a consumption view. You really start with the outputs, the products, the buildings, placing demands on the workload drawing on the salary and the spending. This company would probably, I think, have better insights about how to either make less profitable customers more profitable, maybe, quite frankly, pull the plug and abandon some unprofitable customers, let those big boys lose money on them. So that's really where cost accounting fits in. It really provides insights for making better decisions to take actions.
Thank you, Gary. Any other thoughts from our panelists or reaction from our guests on costs, causality, tracking specifically to customers, challenges, tracking profitability to one building versus another?
Well, the one thing that hit me when I read the case was that they seem to go straight from a marketing strategy to execution without going through the validation process. And the validation process is what requires those good causality-based models. The ability to see how things actually connect together and impact each other, and how the execution of the strategy would require certain costs be incurred because the operational support has to be there and the investment would have to be there. And to be able to use that to create the roadmap, well, first of all, to evaluate the strategy to see if it needed to loop back and be modified, but then also to create the roadmap on how you get from formulation to successful execution. If you don't have a roadmap on how you're going to get from one place to another, you can never tell where you are on the route and if things aren't going right, what went wrong. And so again, being able to use the cause and effect based models, how things actually connect, how the economics that underlie it actually work, and be able to tie those together with effective causal models. You're just sort of shooting from the hip once you come up with a strategy, and then you start to go doing things. They may have had some of that stuff that, you know, just the case study is too short to mention them all. But to me, the validation part was missing before the execution part began.
Thank you, Gary. Or I'm sorry, Doug. Thank you, Doug. And Gary, of course. Let me just introduce revenue management briefly here. And our time is starting to run short. Then we need to move to Jared's final concluding comments. I'm going to share screen again. This is a model that represents the core of our revenue management fundamentals, SMA, a statement on management accounting. Accountants tend to be much more rigorous about investment management, cost management. We've had modeling and framing and reporting and measurements going on there for a century. Less so on the revenue management side, which tends to be in the hands of our marketing and sales colleagues and should be. Primarily, you know, their bailiwick, but accountants have this rigor of data and modeling that can be brought to bear into this critical top side of the income statement if we are mindful about what the levers are. And the 4 levers of revenue management, based on some key research from some colleagues of ours down in New Zealand, our first 2 levers on the demand side. The demand side is about driving revenue, and it's all based on customer segmentation. Now, as Doug mentioned, this is a short case, which is, in my experience as an MBA professor, makes students very happy. Short cases are always preferred, not just because they're easier to read through, but it creates a space for us to bring our own ideas and assumptions into the discussion, our own experiences. So we don't have a lot of information about the specifics of customers at Xanaf, but we have Jared here, and we can imagine that these customers can be segmented in terms of how they value on-net fiber networks, how they use those networks to create their own, to solve their own problems and support their own processes is how they value them. And how they value customer segment by customer segment should be how prices are based, not based on costs, not based on competition, but based on the specific characteristics of customer segments, what value they get. And then we allocate our resources, our inventory, but we mean this broadly, our capital investments, our people investments, our time are allocated within these customer segments based on pricing and margins and available demand within each of these segments. We can choose to be more data-driven and specific in our management models about how we track on set customer segmentations to set prices and allocate our resources into those bases. That's about creating more revenue volume. But on the asset side or the balance sheet side of this is we are deploying resources, not just traditional assets, all of the resources into the supporting and harvesting demand. And there's an efficiency there, and there's two levers of efficiency and effectiveness. One is how we configure product that we're selling. Not that we're going to, because we need to continually refresh, re-innovate, re-engineer the product to maintain demand in the face of competition and expectations of clients that are ever increasing. There are ways to configure products that are more efficient, largely configuring around contracts and delivery, rather than less efficient, where we're configuring the core of the product itself, which requires more resource spend. And there are ways that we manage how they consume on those products. That's the duration control. We have high and low points of demand, and this may or may not be relevant, Jared, to Xanaf, but to the extent that there or systems or construction of new buildings, there are demand points that are exceeding the capability, then we've got to be mindful of how we deploy around those bottlenecks. And we might also work on managing customer behavior to incentivize them to come to the company to request more fiber builds at times of the year when we have more availability, or use the data flowing through those fibers, through those fiber networks, more so during times of otherwise low demand, in the classic sense of happy hour at restaurants. But these four levers, if finance and accountants are intentional about them, are potential to be deployed. Jared, any thoughts about how these different aspects of managing revenue might be applicable in this case?
I think it sounded, what really rung was the fact that you mentioned, the looking at the customers. I don't think they actually, stratified the customers. The focus was just, build, get a customer and build. I think what you mentioned is if you have a customer that you knew would grow, buy more services, was somebody that was likely to stick. I'm not sure they spent a whole lot of time. I know marketing did have a list of, good blue chip customers, but they weren't really saying, yeah, we won't do this building because this customer doesn't look very, they were, I'll be honest with you, at that point, sales was running a lot of it. And if you tell a sales guy you're not going to build because you just want a customer, they would get really ticked off. Right. So I think it was the fact that, there wasn't that much discipline put into it. But to your point, I think if they looked at this model, they could have made this program so much richer and so much more lasting by doing a little bit more homework and looking a little bit more have insightful, rather than just the typical P&L metrics. Revenue's going up, EBITDA's going up, but the length and quality of customers, the future revenue you could derive from these customers, the number of different locations these customers may have within our footprint that we could sell to, all of those should have been used as a prioritization.
Monty, this is Gary. I have a call on the top of the hour. I'm gonna have to leave, but I just want to make an observation. If we presume that the big cable carriers and maybe some of the competitors have sophisticated systems more than Xanaf, that would be one way to think. But let's imagine that they don't. Then if Xanaf actually used these more progressive methods, I like to use the phrase, in the land of the blind, the one-eyed man is king. In the land of the blind, the one-eyed man is king. You just have really much better data to be competitive, and the data becomes really a competitive advantage, the analytics. So very much enjoyed the case. I'm sorry, I got to scoot, so I'm going to have to log off at this point.
You're going to
Carry
go work
on.
with a client, do actual value-added work, Gary. Good on you. Thanks for spending time with
and one
us.
quick observation, if people do want to know more about customer profitability, one of the PACE webinars we did several weeks ago, I presented, is called Measuring and Managing Customer Profitability. It's on the PACE website if you want to download and see that.
Thanks, Gary.
Bye.
That customer profitability webinar that Gary did is excellent, and we strongly recommend it here. We are moving now to towards the end. Let's consider some of the questions we heard yesterday, Rafe, and customer profitability. I know was one question that Gary, I think, was addressing that before he left. But what questions were you hearing yesterday?
Well, there were two that were somewhat related. One was, what would be the impact of COVID-19 on this type of plan for the organization?
Yeah, I think, yeah, this was done pre-COVID, and I think with COVID and more people working remote, you know, the amount of bandwidth in offices now, probably they're sitting with excess capacity because nobody's going in there, so people are working from home. But a lot of their main data and storage and servers are still kept at the head office sites, and many of these networks were also linked to the customers' data centers. So, you know, I think they still have some value, but they would probably be a slight change in terms of the volumes. But I think eventually people would realize that, and I think in the new world, people will realize that people are going to go back, and whether it be 3-4 days in the office, the volumes will probably be similar, if not get back to the same as what it was pre-COVID for the data volumes in those buildings.
Right, great, thank you. And then somewhat related, is a 5-year plan, which is what this company was using, a 5-year planning cycle, appropriate in this day and age?
Yeah, they had a 3 and a 5, and I think because these were long-term asset investments, they wanted to see the future growth, and many of these models that they had showed, you know, if I build now, what will things look like in 5 years in recurring revenue and so on. I think you're right. I mean, things change. Competitor could have come in. In fact, this company was under review. A lot of people were trying to take it over or buy it. So they were looking. They did like to look far forward, and they did, which is good because they were trying to anticipate the whole industry and where things were going to go in this tech space. Although things do change quite frequently, you're right.
Great.
We need to move to conclusion now. I have a slide here that is provided to us by Jared based on the results of this company. They didn't apply, of course, this particular framework we've been discussing, but they applied good data analytics and good things started to happen. Can we hear about how the company is doing subsequently?
Yeah, I think they didn't. Obviously, they didn't use all the PACE models, but within what they knew and what they thought of, based on the finance deep dive and the reports that were produced, you know, they did go back, marketing and sales, and did develop programs to promote subsequent builds in initially fibered buildings, and now 75% of the buildings have subsequent circuits there, which significantly increased revenue. And they actually did start looking at additional revenues that were being captured by these customers. They started selling them voice and other products, which was just an add-on. The CapEx efficiency improved as they were able to significantly reduce costs, find innovative ways to get to buildings rather than just keep going around obstacles. They found and they were able to get sales to negotiate these one-time extra charges to get around obstacles to get to the buildings, and many customers who really wanted these services were okay with that. Many of the big companies actually wanted them, asked customers to do that, so we weren't out of line there. And then sales also subsequently avoided new buildings with less than 2 tenants because they just didn't want to have too many potential assets being sidelined because of the fact that the customer either went to a new provider or left the building. So I think that was really good kind of turnaround from the initial program.
Better data, better focus. Yeah.
And conclusion, I think, was the last piece. I think what the last page was the conclusion that, the impact, there's no question, deep analytics, building by building, every one of those 500 buildings was there as almost like a stock with the payback and the cost and all of the potential customers there. So that kind of detail allowed the firm to make significant improvements in its program, and they did see underperforming buildings, and build costs are way higher than they expected. And once you see that in a report and executives see that information, then they can really demand action from their sales and marketing group. And I think that was the catalyst that allowed them to really improve the success of this program.
Thank you. To our guest, Jared D'Souza, thank you for the time you spent working with us in a special interest group to design this case for Profitability Analytics Center of Excellence. Thank you for coming back again to help provide this webinar for a second time. You are, those of you who are watching this is version 2.0 of this webinar. It's been just a delight to be back with my colleagues, the original co-founders of PACE, who served as panelists for today's case discussion. If you're interested in joining the conversation, to be part of the work that we're doing here, we invite you into any number of connection opportunities. We have, first of all, a website, profitability-analytics.org, and I'll show you that on the next slide. You can register to be a member of PACE. We're a nonprofit organization focused around solely building better modeling and better vocabulary for business management in the world of accounting and finance. We have discussion forums there that you can participate in. We have a LinkedIn group. If you search for Profitability Analytics, you'll find us on LinkedIn. We invite you to join that group area on LinkedIn. We have this webinar series. This is a webinar that represents a monthly event, and this recording will be on our YouTube channel and on the PACE website. I mentioned special interest groups are forming around particular industries or particular issues. We please welcome you to email us your ideas, your comments, your feedback. There's our email address at the bottom, profitabilityanalytics@gmail.com. No hyphen in that one. The hyphen is in the internet address. Thank you for the time you spent to attend to our webinar. Thanks to our participants who actually attended yesterday in version 1.0. And thank you to, again, our panelists and to our special guest, Gerard D'Souza. Thanks, and enjoy the rest of whatever day that you're having when you watch this recording.
Thank you.
Doug,
Take care, everybody.
Gerard, Rafe, bye-bye.
Bye.